I wouldn't say the war and inflation is won, but certainly the trend is in the right direction. And also the speed of the victory differs depending on what country or what region that you're in. If we look at the ECB, Canada, underlying inflation is around 2.8% or 2.9%. So although it's not at target, the target of 2%, the trend is enough for those central banks to think, okay, we need to take the foot off the brakes and we need to add some stimulus to the economy.
As you say, inflation in Canada is still above the target of 2%. What are they seeing? Why did they cut?
Well, there's a lot of similarities between Canada and Australia. So Canada, GDP growth of 0.5%, it's a little bit slower than what the central bank would like. If you look at growth or GDP growth on a per capita basis, then Canada is actually in contraction, which is the same situation for Australia. Coupled with that, wages growth has been trending down. In Canada, wages growth, the most recent measure, 3.8% year on year. That's come down a lot from last year, where it was above 4%. So with wages growth trending generally in the right direction, with GDP growth probably a little bit lower than what they like, they feel that they can preempt the target, they can cut rates before inflation hits its target.
Given the similarities between Australia and Canada and the fact that Australian inflation is getting closer to target, why do you think the RBA isn't considering an imminent move down?
Well, if you look at Australia, we should probably consider the RBA's preferred measure of inflation, underlying inflation, which is called the trimmed mean. And if we look at the most recent trimmed mean that came out last week, the year-on-year number is 4.1%. So compared to Canada, 2.8, we're at 4.1, quite a bit higher. The other thing, our wages growth is higher than Canada and higher than the ECB, the euro area. Our most recent wages growth number, 4.1%. It's a little bit high. So there's no value, there's nothing for the RBA to gain by being too fast on cutting rates. They can wait for the quarterly data. The quarterly data for inflation has the full data set, 100% of the CPI basket. The monthly data set, it doesn't have that. It has about 60% of the basket. So we suspect they'll wait. We're not expecting rate cuts at least until February next year.
And I suppose it's fair to note as well, Australia's cash rate at 4.35% hasn't gone as high as Canada or the US.
There's a couple of different reasons for that, but the main ones, number one, we have an enterprise bargaining system in terms of wages. That's slow to move, so as inflation occurs, it takes longer for wages to change in Australia, particularly in regard to the US. So Australia, most mortgages are variable rate. In Canada and the US, and particularly in the US, most mortgages are fixed rate. In the ECB or in Europe, it's a little bit of a mix, but if you look at the main countries, France and Germany, most of their mortgages are fixed rate as well. So when the central banks raise rates, it takes a lot longer for it to impact mortgages, the cost of mortgages or interest. And so it takes longer to impact the consumer. So what central banks tend to do in these countries is that they raise rates faster than Australia and they raise them higher because they're trying to have an impact on the consumer straight away through personal credit and the cost of credit there and trying to have an impact on businesses straight away as well.
Now, we've seen moves in markets in response to what's happened in Canada. US Treasury yields fell and bonds rallied. So what's the bond market telling us about the rates outlook?
Yes, it's interesting. I've been in markets for a long time, and you look at the data, you look at the consensus, and the consensus is that rate cuts are coming. And we've already seen rate cuts happen in different countries. But It's not until the market sees the whites of its eyes, until it sees the actual cuts coming through, that it fully factors in what central banks are doing. For us, we think that it's the beginning of a rate cut cycle. We see 2 rate cuts, our official view at UBS, 2 rate cuts in the US, beginning in September for this year, and then probably a rate cut each quarter next year after that. As I mentioned earlier, we think the ECB will cut tonight. And then, again, very much like in the States, we think that there'll be a steady rate cut cycle, probably once every quarter.
So you think markets have got it right with the US market at record levels, that rate cuts are coming?
It's all going to depend on inflation. It's all going to depend on wages outcomes. If we look at the equities market now, the market is expensive. If you look at the US, if you look at Australia, if you base it on a price to earnings multiple, both markets are about a standard deviation more expensive than the normal PE, the normal historical PE. So what does that mean for the US? It's about 15 to 20% more expensive than where it usually trades, and the same for Australia. But what we're telling clients is don't follow the herd. We're saying to clients, keep your powder dry, or have some powder dry. We have a full allocation to equities, but given that valuations are so high, that any misstep in terms of unexpected inflation could have an outsized impact on bond yields, that there may be a sell-off, there should be some sort of sell-off, there usually is, to take advantage of. And so that's what we're saying to clients. Have a full allocation and wait for a sell-off.
So, Andrew McAuley, do you think it's fair to say that the majority of the good news around potential rate cuts is already priced in, and there is now risk of a sell-off if we do see inflation surprise on the upside?
There's definitely risk of a sell-off if inflation proves stickier than what the market's expecting. That's because markets, or equity markets, are priced at a very high PE. It's not all due to a revaluation or bullishness based on lower interest rates. We can't ignore the impact of the artificial intelligence earnings boom. And certainly for the US, that's really driving the market there. But even with that, PEs have expanded, and if inflation does surprise to the upside for a consistent amount of time, and central banks have to pull back on rate cuts, then expectations will change.
Andrew McAuley, thank you so much. We appreciate your insights.
Thank you very much.